Check 1, 2, 3. Good evening, everyone. Good evening. I hope everyone had a good day today. Okay, let's do a quick sound check to just check whether I am coming across. Good evening, everyone. Can I get a shout out if you are able to hear me? Just a hi, hello, good evening, whatever we do. All good? Perfect. All right. So I hope everyone's had a good session today, and it was an interesting day in the markets, right? We broke past that 21,820 supply, and we finished at the upper end at 21,970. 21,595, okay, is where it went up to. And I do hope, okay, that everyone, okay, was into a long call or a short put and have generated a green MTM for yourselves, right? It was one of those classic days. The market is different actually for different days of the week, but today was a call buyer kind of a day. Yesterday, okay, you can see, okay, it was a writers day. We had a nifty settlement, and the writers, okay, were in control, right? They kept that price at 21,650. In fact, it closed over there at 21,650. But today 21,750, and the fact, okay, that we went up and took out, okay, that 21,820 supply reference was enough, okay, to indicate, okay, that the market, okay, wanted to go up today, and driven, of course, okay, by what happened, okay, in the IT index today. That was, okay, the one, okay, which took it. The bank nifty and stocks like Reliance joined up also, and did, okay, what they had to do, right? So overall, okay, it was a good session. If you got the bias of the market right, then you're definitely in a green MTM today, right? So what we're doing today is yeah, of course, okay, got an order flow chart for you on screen. I just want to spend a couple of minutes, not more than that, because our agenda is slightly different today. And we are going to be speaking about Spectrum, we're going to be speaking about Gamma, and we're going to be speaking about Delta OI. But I just want to spend a few minutes over here and understand with you all what really happened today. And right at the open, okay, we've seen, okay, this Nifty do this buying right at the open. That told us, okay, that there was some kind of buyer dominated wave today. But the crux, okay, came here, okay, when we took out this 21,820 and all this buying, initiative buying, this IB candle is what was the reason we took out all this and we had that move lower, right? So what we've got is an signal in order flow, which is on a 30-minute time frame. And what we've been speaking to you about is utilizing that power of 10, this power of 10 bars, that is, and this is coming at about 9:45. So till Monday morning, okay, we can say safely that 21,775, the lows of that IB bar are support, and we can expect this market to go onwards. I personally, okay, was expecting, okay, hit around 22,035 in the futures, considering, okay, that we took out that 21,930 reference also. But we saw, okay, a little bit of profit booking right here. All these reds came up around 21,955. This was telling us, okay, that the market, okay, wanted to go with profits, wanted to book profits, and why not? Okay, we've come up from about 21,750 right up to about 22,000 for a move of about 250 points one way, and it made sense, okay, that there was some profit booking, okay, which came in at that big round number, 21,995, 22,000, and the market, okay, took some profits home, right? But overall, what it has done is, if I can come back, okay, to a market profile chart with you, what it has done is, from a market profile perspective, we've got these A period singles, okay, which have come in at about 21,734 today, and this will be now considered a support going into the rest of the series of Jan. Remember, the A period singles, whenever they show up on profiles, are very, very decisive. We saw them at that trip down to 21,500 on Wednesday, right? So this market had dipped at this low, and this is what we call an A period single. And we've explained this to you, okay, in our e-courses. We've explained this to you in our training library. And whenever they show up on a profile chart, they are considered to be a very strong indicator of short-term change. So this was more of a responsive buying pattern. Yesterday, okay, we did not go up, being settlement day, because we had A period singles at the top, and it had to be taken out by another set of A period singles, which is what happened today. So that's why the seller was nullified, the buyer came in, the confirmation of it is also there in the order flow. And it's always a wonderful trade, okay, when everything, okay, comes together, and there are, you know, those bits and pieces, okay, all come together and form, okay, that puzzle together. That is, okay, when everything, okay, is there, proper, prim and proper and in place, and we say, okay, that is the making of an excellent trade. Not all trades are alike, but this particular situation, okay, which happened today, was that classic trade. The market profile was right, the order flow was right, and everything, okay, went, okay, to the book, to the proper book. And you can say, when such a pattern repeats itself, 8 out of 10 trades you take out of this pattern. I'm saying 8 out of 10, that's about 80% of trades, okay, you take out of this kind of a pattern, will result in profits for you, right? So looking ahead, okay, on to next week, we will do a review. But only thing, okay, which has happened is this profit booking, okay, which is coming at the top. So for the market, okay, to move further beyond that 22,030 level, the market will have to add demand, right? So otherwise, in a perfect day, the only thing, okay, which has happened is some of the demand is come off. There is profit booking, and you need to be always careful when you see the POC drift right up to the top, right? So continue, okay, on with that. We've done a lot of studies, okay, on the market profile with you. You can go down to youtube.com/wetrender, where you are right now. You can go, okay, to our previous live videos, both on our Twitter as well as Instagram, and go through it. There's a lot of information within the market profile to be confirmed by the order flow. And when it confirms, okay, you set yourself up, okay, for some excellent trades, right? What we like to talk about generally is that the market is like a puzzle. You know, those puzzles, okay, which are given to kids, okay, where different pieces are together. Jigsaw puzzle is what we call them. Pieces, different pieces of different shapes, different structures, okay, and they are put aside all differently. And then, okay, you have to have a strategy and a plan in place, okay, to put all of them together, so that, okay, you come in as a good picture and you complete that puzzle. And you may not know, okay, what every single key is doing, but even if you get about 60% of that right, you can figure out, okay, the rest which you do not understand, and you can put together that picture. That is how, okay, we understand the market. We do not claim to understand every part of it, but if you can understand about 40 to 60% of the market, you will be very clear about what you do not understand. But when you understand, okay, that 60%, you know, okay, what you do not understand, you have almost an 80% chance of going out there and getting to what you want, which is very good trades and a very good trading account and excellent MTM for yourselves, right? So today the agenda is slightly different. We are not going to be talking about market profile and order flow. We're going to be talking about something called the spectrum. We're going to be talking about something called gamma, and we are going to be talking about something called delta OI. So these are the three topics we are going to be covering today. But first and foremost, okay, why do we have to cover these topics, and why do we need to know what this is happening? So all these three, the spectrum, the gamma, and the delta OI, form a part of the market, which is about what the other traders are doing in the market, right? So it's always about two things. It's you looking at your chart and understanding what the chart is doing so that you can enter a trade in the market. That's one part of it. The second part of it is what are other traders doing in the market, and how are they positioned with their bias or with their set of belief systems or with their set of processes in the market. So that is always the other part, and we call this other part the inventory or the participation of other traders in the market, right? Now all of this is not just a random bias in the market. It's money backed positions. That means these traders have packed money into their strategy, have packed money into their process, and they have built a position which is of course to run into a profit later on. But understanding where they are and how they are placed is a part of the process which we follow and which we believe in at WeTrender, right? So today's session is we've spoken about market profile and order flow, which was all about our approach to markets. Today's session we want to focus on understanding what the rest of the market is doing, right? And the first thing which we do when we look at what other traders are doing in the market is we understand it by way of something which we call the spectrum chart. Now what is the spectrum? The spectrum you will find from your menu. If you go down, scroll down, market profile, order flow, options table, Greeks table, index table, you'll come to number 7 on that list, which is the spectrum. And we have different spectrums for Nifty, Bank Nifty, Fin Nifty, and Mid Cap Nifty. Now what we are doing via the spectrum is we are focusing on the short term movement of the market. So that's the movement of the market from one weekly expiry to the next weekly expiry. And what we're trying to do is we are trying to anticipate, based on the existing positions of the market, where the market could possibly go to in the next 5 days. Now this is not for the next 1 month, which is the monthly series, which most people also trade today, but predominantly the money is now more in the weekly series, the front week series, the series which is expiring, and you can do that. You can have a look at that by looking at the options table and focusing on any one strike over here. So let's say we go in with today was a buy side dominated day, so first day of the week. So you even look at the 21,900, it was about 71,000 contracts up today on the weekly. But if you look at the monthly, the same 21,900 is got about 15,000 contracts up today, right? So this is the monthly series, which is the 25th of Jan. And I'm going back to the 18th of Jan, which is the next weekly series 6 days from now. So that's about up 71,000 contracts, right? So what does that tell you? That tells you that traders today are focusing more on the current week than the week which is to come, or the monthly settlement. And we have to use this data and understand what kind of positioning is happening, right? So this is 21,900, 70,000 contracts came today, but what about the rest of the rest of the strikes? What about the rest of the places where the calls and the puts are traded? How are traders anticipating that move to be? So we came up with what we call First of all, let me just take out the rest of the elements on this chart, and I'll just talk to you in brief about what this is. So we came up, okay, with this study where we plotted a high and a low, okay, and we call this gamma wall high and gamma wall low. Now, what is this gamma wall high and gamma wall low? It's also a range of the market, okay, for the expected week. Okay, now to understand gamma, you'll have to, okay, look up and Google gamma second order Greek. Okay, so all the delta, gamma, theta, rho, and all that things. Okay, if you can just Google it, okay, you'll get a very good understanding, okay, about what I am talking about. Since, okay, I've got a lot of ground to cover, I'm not going to go into the basics of gamma, but we've got some videos on YouTube as well. But your best friend for understanding gamma is still Google. And if you Google that term gamma in options, you will get a very good idea about what gamma can do in the markets, right? But we use this data from the gamma of options, and we've arrived at a range for the coming series. So this range right now is 22,100 to about 21,700. So the first question you have to ask, right? Okay, it is 500 400 point range. Okay, what does it make? What does it mean? Okay, and how am I going to find it useful, right? So what really happens on the first day of the week, traders position themselves, okay, for an expected movement through the week. So if you go back and look at last weekly series, that was on the 5th of Jan. We began that Friday session. This was the level that they had in mind, which was roughly around that 21,900 level. And the lower level, okay, they positioned themselves was about 21,500. Right? And if you look at the activity from last Friday to yesterday's settlement, it was confined. This is actually the price bars, okay, can show you, but you can go back to your charts, okay, and you can have a look at it. Most of the activity was confined within that 21,900 and 21,500. Now, this does not mean that everything, okay, was 100% confirmed within that. As the market ebbs and flows, as it moves up and down, okay, you will see, okay, that there are some changes happening, right? So it went lower, they booked profit on the higher strikes, they came lower, then, okay, they thought, okay, there was a little bit of risk, they went higher, they came lower over here, okay, all the time. Okay, at one point of time, okay, they even thought, okay, that 21,500 was going to be broken, and they went, okay, slightly lower to 21,400, okay, for one day, which was yesterday. This is just, okay, risk management, okay, which happens. But broadly speaking, the consensus, okay, which is established on a Friday, is to be monitored through Monday, Tuesday, Wednesday, and the last day of the week. The last day of the week, okay, this is not really that important, but most traders would pick up positions for the coming settlement based on, okay, their planning and their preparation on the first day of the week. So all these people, okay, who added that open interest, like I showed you on that 21,900 PE, and they're carrying home that position, they have a plan in mind, and the planning is actually anticipating 22,100 on the higher side and 21,700 on the lower side. So this is the first thing, okay, we pick up, okay, from a spectrum chart. Now, mind you, these are Nifty spot levels. So we're not talking about futures over here. We're talking about the price out of the Nifty spot index. So we're looking at Nifty over here, which is the spot. So when I say 22,100, I'm referring to the 22,100 spot. So what else, okay, do I have over here? So I have the futures premium added, which goes up and down. So today, okay, on that gap up, okay, we had that big dip. We were speaking extensively about it, about how it suddenly, okay, dropped down to about 40. And you can, okay, keep an eye out on this premium as the day goes on. And you have something, okay, which we call the gamma zero. This is that dotted line of the spectrum chart. Now, this is actual hero of this chart, right? The gamma 011, we've computed, okay, this number, okay, through a set of calculations all based on the existing position of traders in the market. But fairly, to put it very simple, in simple terms, the market is said to be positive when it is above the gamma zero line. Like today, the gamma zero was 21,800 and the market stayed about 21,800. So you can adopt a positive bias. If it dips strongly below the gamma zero, you can expect some selling. Or if it stays closer to the gamma zero, like all of yesterday, you can see that the market is flat or is gonna be range bound or at a particular place, right? But if it's decisively above a gamma zero line, then you can adopt a positive bias for the entire day. Best example, I can point out to you is today. And whenever the market decisively breaks down and gamma zero stays up, that means that market is going to be short term going down, right? Now this does not mean that the gamma zero is a default line on the chart and it's going to be there. The gamma zero has got a life of its own, and remember, it is about traders who have built positions in the market. So the gamma zero is gonna keep moving. So today it was stable at 21,800, but it can go down to 21,900. It can go down to 22,100. It can go down to 21,700. But most of the time, 95% of the time, it's gonna be within this range, right? But there is a condition over here, which we call a sniper, SNIPER, wherein if this gamma zero meets an extreme, like this gamma wall high, the blue line over here, we can adopt a short position in the market. If this gamma zero meets the lower line, which is the 21,700 in this case, we can adopt a long position in the market. Again, that same chain of thought, that the market is positive above gamma zero and negative below gamma zero. Okay, so if it goes above 22,100, we know that the MVIS line is not moving up. Okay, if it moves up, we'll have to of course take the stop and move out. But 8 out of 10 cases, we would be short in the market that day, right? So that is just one condition of the gamma zero. It can touch either one of these gamma wall highs and the gamma wall lows, and that would create another condition for the market. But to put it simply, a market above gamma zero is a market which is positive and moving up, and a market below gamma zero is a market which is negative and moving down, and a market at gamma zero is a market which is flat, right? Now, this is actually a view over 5 sessions, which is that current week. But what do you do as an intraday trader? How do you know that the market is adjusting inventory as an intraday trader? So for that, you get into the picture something called a market visualization high, which is here as MVIS high, and a market visualization low, which is the MVIS low, which is these yellow. So on your screen right now, we introduced 2 other elements which are about the market inventory adjusting itself intraday. So there is still a view that the range of the market is going to be 22,100 to 21,700, but traders are expecting a short-term 100-point upside in the Nifty, which may or may not sustain, but they don't want to take a chance. So what do? They either adjust or close some of their existing positions or build another hedge for it. Now, what do I mean by that? So suppose a trader has, or rather an institution has got a 21,800 CEPE short. So he sold a straddle 21,800 CE and he sold a straddle 21,800 PE, right? The market opens at 9:30, 9:45, something changes in the market. The order flow suddenly finds another institution who's buying heavily, or something else happens, and our institution who's got that straddle suddenly starts feeling that, oh, my 21,800 CEPE is not really a good trade for the next 1 hour because the market has got a chance to run up to about 21,950, right? So what does he do? Okay, so he may not break that 21,800 CEPE. He will add an extra measure to the 21,800 PE to protect himself from upsides, or he will introduce a 21,850 call long. Okay, so that okay, the damage okay from the up move in 21,800 CE is minimized or managed, right? So it is just option adjustments which can happen. This is something okay which we track via these yellow lines over here. So we say when let me just go to a 1-day chart, so we'll have a better understanding of this yellow. So right now, right at the open today, whenever this yellow moves up, in this case, okay, this MBIS high I'm talking about, this yellow, it's moved up. We can see, okay, that it is money adjusting positions, and you get a confirmation of this via your order flow chart also. The order flow, okay, will show your initiative buyers and initiative sellers. What actually it is actually, okay, all that information coming up and showing itself up in another screen. But whenever the market is adjusting inventory or big players are adjusting, this yellow, okay, would move up. Okay, and that is a trader, okay, who's adjusted position. If it goes flat again, yes, okay, the market is flat. But anytime, okay, they feel, okay, that there is an upward move coming, it can move up to this line also, right? A big change in the market behavior, would also mean that this blue line, okay, would adjust itself, right? So this is again based on the positioning of the market. It's currently at 22,100, but for some reason all traders think, okay, now okay, the range of the market has increased, it can go to 22,300. So you will find this, okay, at 22,300. But what we are doing via a spectrum chart is we are trying to understand where the market can possibly go to, and we are trying to find a direction for ourselves on this chart. So this one chart is enough for us, okay, to understand what the market is doing at every point in time. Okay, again, okay, it's not like throwing darts on an empty wall. This is all scientific data. This is a process data. This is data, okay, which is vetted and which is understood and which has been scrutinized and known, okay, to work in a certain way. Again, we are not claiming that we know all the sides to the jigsaw puzzle, but we know enough, okay, to know, okay, what we do not know, and we're using, okay, what we know and the evidence of what we know to form a better understanding of what the market can do, right? So this is the spectrum. So you'll broadly, okay, talk about the spectrum as having a gamma wall high and a gamma wall low, which are these lines. So you'll form a range for the coming week. Okay, based on this range, okay, you will then plot the gamma zero line, which is clicking on this blue dotted, and you look to see if this market is above the gamma zero or below the gamma zero. Now understand, okay, the rule, okay, the market above gamma zero is a market, okay, which is dominated by buyers, and the market below gamma zero is a market dominated by sellers. If you're an intraday trader, you will add the MBIS high and the MBIS low by clicking any of these buttons over here. These okay, you can click on and off. So you add this, okay, to your chart. You'll be getting a yellow reference line on your screen, and this yellow line, okay, you look at these things, okay, sloping up or down, will tell you, okay, whether the market is adjusting inventory or not. One word to describe spectrum is it's about inventory. It's not about the buying, and it's not about a line on a price chart. Now, good, I remembered that because I have to clarify a very important thing over here. A lot of traders, especially a lot of newbie traders, when they look at a price chart and they see lines drawn on a chart, the first level of thinking, okay, they have is that this is a line drawn above price is a resistance, and a line drawn below price is a support, right? So we have to walk away from that line of thinking when it comes to looking at the entire market picture. Okay, the market on the whole knows no support, knows no resistance. Everything is demand and supply, right? So there's nothing called even a 21820F level. As good as a supply it was, I knew okay one day it could be broken, and it got broken. Okay, today we were okay working on that for about 2 weeks, and it had to be broken because there's nothing called a finite resistance in the market. If the demand okay suddenly okay shoots up, then all the resistances can be blown out. Same thing okay with the market at 20 to 20,000, it can go 10%, 20%, maybe, who knows, okay, it can make okay two big gap downs okay on an unforeseen event. Also it could be 40% down in the next 1 week also if some bad thing happens, right? So there's nothing okay called a completely believable support, there's nothing called a completely believable resistance. It's all demand and supply. So when we're asking you to look at the spectrum, we're asking you to walk away from that thought, which is this is a resistance and this is a support. It's not like that. It's just the positioning of the market. The current positioning of the market is projecting this as a range, and that is the range okay which we need to track forward to, right? So that is the spectrum for now. I'll just move onwards okay to advanced way of looking at the spectrum, okay, and that is what we call the gamma chart. Now how do I get this gamma chart? I move down here. If I go into options strike wise gamma, now it should be clearer. I go into what is called a gamma chart, right? Now this is okay a chart on screen. This would look like your open interest tables, but the entire calculation is very different. So we have open interest tables also, which I'm sure okay all of you are very familiar with, and this is okay how an open interest table okay would look at. Okay, I'm not going to spend a lot of time on open interest because it's a subject okay which everybody knows about and everybody is an expert at it. And today's webinar is not really okay about open interest. It's about understanding okay what else we can find out about the market, right? So this is the gamma chart of all that we looked at in the spectrum. It's a different visualization method of that same picture put up in a different way. So this works like the open interest. So the first thing okay which you do is you go into the plot type and you understand okay where okay the gamma concentration is high. So in this case uh, we've had a very good build up at 21,800, and the gamma exposure was very high at 21,800. It reached up to this level of 1,000, which is very low actually for a Friday, but this okay really shoots up into the higher 40, 50, 60,000 on a Thursday because it's a build up over 7 or 8 days. This is positioning for this expiry, which is the 18th of Jan, and we're looking at it only on the 12th of Jan. Now this is the first day and it is going to keep building. Okay, now this gamma is extremely important to look at on the second last day of the series and the last day of the series, which in the Nifty would be the Wednesday and the Thursday, and it can tell you a bit more about the market and what it possibly can do, right? Now there are two concepts I'd like to talk to you about the gamma visualization, and this is, like I said, it works a little bit better on settlement days and the day before the settlement day. But you have to understand two terms about gamma. And the first term, okay, which I want to talk to you about is something called a pinning effect. Pinning, pinning effect. It's like one stack of column, okay, where the entire market is. Now, what exactly is the pinning effect? So a pinning effect is a market 100% sure that this is the zone in which the closing or the settlement price would be, okay, and therefore those traders who are 100% sure that that is going to be the strike at which the settlement is going to be, they start building positions around that level. Okay, what really happens is as those positions get built up, other traders notice it and open interest starts increasing, and higher open interest attracts even more higher open interest. Resultant is that at one particular strike, sometimes on a settlement day, you will find okay up to about what I've seen, okay, about 12 lakh contracts on the Fin Nifty. I've seen about 25 lakhs contracts aggregated on the Nifty. I've seen about 18-20 lakhs contracts aggregated on the Bank Nifty. Now, this is in number of contracts. So when a large number of contracts, and for us, okay, that number is still 1 million or 10 lakhs. Whenever, okay, that number aggregates at a particular strike, 8 out of 10 times the settlement is going to be at that strike. So this is completely based on something called gamma exposure, and gamma is the reason a lot of open interest gets built up in the market, right? Now, a lot of traders, when they build open interest, they look at price. Okay, and if let's say, okay, we are at about 21,970 right now, that's the futures. The spot, okay, could be about 21,950. So if price is about 21,950, what will they do? They will write 21,900 PE. And if price is below 21,900, they will start writing 21,900 CE. This is a very primitive way of approaching and trading markets. The actual money, the big money, the institutions, they will write only, okay, when they see gamma as high in a market, right? So let me just come back to this gamma value split. So wherever, okay, you see the market has higher gamma, like in this case, there is a higher gamma here at 21,800. The P gamma value is higher. This becomes a strike to write. Not because, okay, price is about 21,800, but because, okay, the gamma value is higher. And you can see over here, this gamma value is higher at 21,700. So this becomes a strike to write. Now you can watch this and better yourself, okay, in open interest. Don't write open interest or don't write positions in the market just because price is at a particular level. Price has got nothing to do, okay, with what can happen next. Price is just an advertising mechanism. Okay, you have to understand structure. You have to understand, okay, option dynamics before you go into deeper writing. So what institutional traders would do, okay, they would focus, okay, on what they are getting in via the gamma, and they would, okay, write, okay, places, okay, of high gamma, such that, okay, it can become more profitable for them. High gamma is equal to higher profits for a lot of institutional traders, right? Also, you can look at this gamma concentration and find out, okay, if this strike, okay, can be broken later, right? So currently, okay, 21,900, we've crossed at the close. This is the spot price, the white line. We've crossed above this 21,900 strike, but this 21,900 gamma is still up over there. So at least, okay, for the next few hours, that is on Monday, of course, these call writers think that they have a chance and this market is not gonna go running higher, right? So just because, okay, price crosses, okay, most of the big traders are not gonna fold positions, and they would, okay, carry positions. So most what they have done is they've secured themselves via a 21,900 PE, and they've carried a 21,900 CE into the market, right? So this is the way to understand gamma. A couple of things, okay, would happen still. Do your writing based on what gamma does, and you can look at the exposure value. And this is still not, okay, environment, okay, to write straddles, but I've spoken about this extensively on my Twitter feed also. I don't like to see environment, okay, which is not like this, okay, to write straddles. So you want to see a pyramiding structure where you have one strong pillar at the top, almost equally balanced to the left and right, and a third set of equally balanced. So if I see this on a Thursday, okay, I'll know, okay, that the market, okay, wants to pin itself, okay, at one particular strike, which in this case, okay, would be about 21,800, right? So this is, okay, how you use your gamma exposure, and you can make better informed trading decisions as you go about your options inventory. I'm just going to pause, okay, for a bit over here. If anybody's got questions about what we just discussed about gamma and about spectrum, okay, please feel free to ask. Okay, so the features, okay, which we are talking to you about on Spectrum and Gamma are available in Premium Plus. They are not in the base line model. These are high-end models, and we've added them in Premium Plus of the of the plans, okay, which we have at VTrender. So do check out, okay, charts.vtrender.com/pricing, and you would, okay, get get all these things, okay, in the Premium Plus plan. Okay, let's move on. Let's move on to something, okay, which is very popular on our charts, and which is what we call the delta OI. So we'll shift a bit of focus, okay, from an understanding of spectrum and an understanding of open interest and an understanding of gamma, sorry, and we'll move into delta OI. But before that, I just wanted to quickly, okay, go to the options table and tell you that you can, okay, pick up any particular option instrument or drop either a market profile chart or a line chart of that directly, okay, on one of these options table. So suppose, okay, I want to see the 21800 call line chart. I just have to go into that options table and click the line. So I'll do that again. I'll go into options table, and right over here on the left hand side, you'll find all these calls, and you'll get these two little boxes over here. The top one is the market profile, and the one, okay, with the slight two arrows, okay, going down here is the line chart. And you will get this on the put side also. You will get this over here, 21800 or whichever, or for all the strikes, you get an option of a market profile chart as well as a line chart. And you get it in the middle. The ones in the middle are for your straddles, right? So if I want to, okay, just click on a 21800 straddle, what I'll do is I'll click in the center here, and I'll have a 21800 straddle up on screen, which is this one over here. That's a 21800 straddle. I can go over here and I can convert this into a line chart by dropping down over here. So let me go back and refresh it. So that's the 21800 straddle for the 18th of Jan. And we can get a line chart also, okay, on this one, right? So this is the 11th of Jan, and this will tell you, okay, about how to, okay, plot this straddle. I'll just come down, okay, to this chart, but before that, I just wanted to talk to you about a small little thing also. You can plot your strangles also via the options table. So for that, okay, we've introduced to you two square boxes on either side of the strike. So suppose, okay, I want to plot a strangle, which is say 21900 call. I'll click this, and I want to plot, okay, 21800 put. I'll click this. I'll get this drop down over here, right at the bottom over here on my screens. Okay, you should see this, and you'll get this open chart link over here, and if you click on that, you'll get a strangle also opened, right? So three things, okay, you can do for yourself. You can either open up the instrument directly, which is your 21700 CE, 21800 CEs, 21900 PEs, 22,000 PEs, or whatever. You can open them both in market profile as well as a line chart. You can open up any straddle of your choice by clicking directly, okay, on the center of the screen on the options table itself, and you can plot a strangle also, right? So having covered that, let's understand, okay, what is there in the line chart for us, okay, to look at. So this is a 21900 CE of today on screen. Okay, let me just strip off all elements of this chart, and we'll talk, okay, about this chart right now. So you can, okay, go back any number of days over here. I of course like to look at everything on an intraday basis or a 1 day basis. So what we have over here is the price chart, and this blue line would be your open interest, which is developing in the instrument. Now let's add data to it. So what we've done is we don't want to add a lot of indicators to our chart. We want to keep our thing and our messaging as simple as possible. So we've added the VWAP, which is in green, and everywhere on our charts you'll find wherever you see a green line, look down and you'll see that it is VWAP. And we've added a line in pink, which is the VPOC or the volume point of control. And everywhere on our charts, again, wherever you look and you find a pink line, you will identify that as a POC or a point of control. Right now, for those people who are not very much familiar with the market profile and the order flow, the POC is simply the point where the highest volume was traded in that particular session. Just remember this words. The word is POC, but in your mind, you should think about POC as the area where the largest volume of trade happened in that session. Right. So in this case, early in the morning, right up to about 12 noon. And how do I know 12 noon? Because I'm looking at the time at the top. Early in the morning, right up to about 12 noon, the largest concentration of volume was at 60. And as we moved higher, the largest concentration of the volume came slightly below 120, about 118 or so. I also know that the VWAP is around that 120 zone. And generally, in an uptrending market, the rule is if price finds itself above VWAP and POC, it is considered to be positive and up, and this open interest is good. It's building up nicely. Right. And if price finds itself below VWAP and POC, it's a dropping market, it's a falling market, and price can go further down. Now what we've done is we've added an element to this which we call the delta OI, and what it does, it manages or monitors big spikes in OI. It monitors or manages big spikes in OI. So every time open interest goes up, like in this case, this green will tell you that the open interest went up, so that there is big money coming into the market. But this information by itself is not enough. You have to know where it came in, and for you that reference level you have to quickly note down is 60. So if it was at that POC and the VWAP, some of this money has come in at 60 rupees. Right? If it drops here, open interest also is dropped. Some big money has booked some small profits back over here. That's why this open interest drop. So every time you see green paneling over here, that tells you that the market is attracting open interest and the market is building up. Now this is not that useful on a Friday because it's the first day of a series, but it gets a life of its own on a settlement day. Repeat that, it gets a life of its own on a settlement day. And just looking at this one chart, where the open interest is spiking and it's not spiking, you'll come to know whether market participants are closing positions or adding positions, or they are finding themselves upside down and therefore closing that open interest, etc. Right? So this is something very, very useful. And if you start watching this on a Wednesday or a Thursday, Wednesday for the bank nifty, Thursday for the nifty, you'll get a very good understanding about how to find where the open interest is changing. Right? So keep that spectrum chart up and you will see this. You also get the same open interest spikes on a market profile chart, but in a live market, you'll be able to see this better. So if you open up your market profile chart, you will see this thing. If you hover over here at about 21,987, there was this spike quantity, and if you can read my screen, you will see that 1290. Now this 1290 is 1290 lots reduced, right? So you will quickly know where these spikes are coming, and they are always larger people. We don't want to deal with all that 1 2 1 2 1 2 3 lots coming in, but at the same time we want to focus on where the big open interest is, because the big open interest, when it moves, when it starts moving in about 1,000, 1,200, 1,290 lots at a time, okay, it tells you, okay, that this market is undergoing change, right? And just to quickly point out to you, this 1290 open interest, which was dropped here, if you can just remember this level, 21,987. So this was the time, okay, it happened. See all this red over here, that is the open interest, okay, coming off right here at 21,978, 830, 300, 177. This is all in number of lots. So what basically it is the same information coming to you via different screens, different visualization techniques, but the same information. But what we are trying to tell you is utilize this information, okay, to your advantage, and know, okay, when, okay, the market, okay, is working differently, and when there is big change happening. Big change does not happen with 1 2 1 2 1 2 lots, okay, moving at a time. That's the job of the market. It is open, it will attract business. But big change can happen when the big player comes, when the big boys come in, and they, okay, decide, okay, what can possibly happen next in the market. So when this all this red came in earlier today, it was our sign, okay, that the market, okay, was dropping, and drop she did, okay, that was about 70 points, okay, it dropped to a lower to about 21,910 and rose up again in the close. But this was a sign, okay, that the market, okay, was dropping, right? So we've covered spectrum, we've covered gamma, we've covered delta OI. Okay, these are different ways you can look at participation of other traders in the market. I'll urge you to get more familiar, okay, with these charts. Okay, a lot of you, I know, okay, are very good open interest tables and open interest traders, and you can, okay, get all your open interest data here also. Okay, but the markets have become faster. Okay, and our thought process at VTrender is why not, okay, have better markets of 2000, the markets of 2010, and the market, okay, in which we are in 2024 are completely different beasts. Okay, they are become faster, and you can make out that, you know, something like an open interest, okay, gets updated every 3 minutes. In 3 minutes, an option can go from 9 rupees to about 40-45 rupees, and people, okay, who have made losses would know, okay, that what impact, okay, that does. So we are living in a time, okay, where we require, okay, faster data. We cannot be, okay, kept in a cage, okay, just because, okay, exchange decides, okay, that open interest, okay, gets updated, okay, every 3 minutes. We spoke to them, okay, we asked them, okay, why not, okay, give it faster. But since, okay, they didn't give it to us, okay, we had to work, okay, with other methods, and one of that method, okay, was order flow. It works on tick data, fastest demand and supply at your fingertips. The other methods, okay, were what we saw in gamma, what we saw in spectrum. It tells you, okay, what is happening in the positioning of the market. So it's up to you. If you're still comfortable with open interest, you're welcome, okay, to use it. But all I'm telling you is that there are other methods out over here which can tell you how best, okay, you can trade this market, right? So final pause, okay, for questions. We've shot over our time today. If there's any more questions, okay, I'd like to take them. Otherwise, I'd like to call the session for a close. Anyone? So the question is, what will happen with the gamma pinning is cross? Yes, it can cross. It can cross. Nothing is 100% in the market. So you will see, okay, in your delta OI charts, which I showed that they are covering. So they are covering, you also cover, right? There's nothing called an absolute in the market. There is no trade which is 100% sure. Whichever systems and whichever processes you apply, if the rest of the market covers, you also cover. So in a gamma chart, the question is, okay, talk about straddle chart. So when we are talking about gamma, okay, we are talking about everything that includes straddle, that includes triangle, that includes long directional calls, puts, everything, right? So gamma is for the entire market, okay, which we are talking about, and individual gamma of every strike, that, okay, you can pick it up, okay, from the Greek table. If you're looking at individual breakup of gamma, it's right here. Okay, so you will find this, okay, gamma of every single instrument in this gamma table over here, Greeks table. All right, so I think we are through with our session today. Will be a recording of this on YouTube. I urge you to go through it once more. Thank you for joining in, and I'll check back with you later on for another webinar next week. Thank you for joining in, guys.